Yes, Warren Buffett makes mistakes too. While that should be encouraging to all investors, and why fixed indexed annuities are bad for your financial health.
This is InvestTalk. Independent thinking, shared success.
Good afternoon, fellow investors, and welcome back to InvestTalk. This is our Monday, May 20th, 2024 edition. I'm Justin Klein, and I'm here, as usual, on most Mondays with Luke Guerrero, who's fresh off a wedding weekend in Miami. How was it there? What was the weather like? Did you pick up any investment themes while you were out there?
Well, let's clarify and say I was not the one that got married.
You were not the one that got married. No.
You were saying that I was fresh off of my own wedding weekend.
No.
Investment theme I picked up. Opportunity cost of having a very expensive wedding in Miami can haunt you for years. Maybe that's an investment theme that I picked up. It was a good time. You know, I don't personally like the heat, which is weird to say for somebody from Southern California, but my girlfriend who has curly hair, as you know, Justin, loves what the humidity does to her hair. So I think, overall we had a good weekend. She's happy. I'm happy. Unfortunately, took a little longer than I would hope to get back, so I'm pretty exhausted, but I'm still excited to talk to anybody who wants to call in today over the next hour.
Yeah, and I'm fresh. I'm ready to go. I'm still recovering from my minor foot surgery, so I was very mellow over the weekend, and I'm jonesing. I'm ready to go. This is an exciting week. We have NVIDIA coming out with earnings on Wednesday. We know that's going to be a market-moving event, one way or the other, but that's not really our main focus on today's show. It's not about one-off earnings reports. It's really about understanding the markets that we are in and how they can be applied to your particular situation so that you can maximize your full potential of the capital that you earn, the capital that you've saved over the years. And that can be difficult. There's a lot of pitfalls as well as opportunities that are out there. And we're here to help you avoid the former and uncover more of the latter. And we do that by answering your finance and investment questions. So we encourage you to give us a call at 888-99-CHART. Now, we're going to run down the market performance for today as well as the show topics. But as usual, we are going to tackle our first caller question now.
Hi, good morning. So I just had a question on what your thoughts about fixed indexed annuities are. All right. Thank you so much. Can't wait to hear the answers. Bye-bye.
I have a simple answer. It is do not come anywhere close to them. Run far away. If anybody is pitching you a fixed index annuity, you should turn around and walk away immediately. I have never, in my 20 plus years in this business, have never once, ever, and I don't know how I could take up the entire show saying ever. I have never, ever had anyone that was happy they bought one. Not one person. And I've talked to thousands and thousands and thousands of people. In addition, Steve, in his prior career, was in the insurance industry. And so he knows the games that are played in the insurance industry. And he knows the good products from the bad because he was intimately involved in many of them. He was investing on behalf of the insurance company in taking the money that people invest in indexed annuities. And so he knows a lot about them, and he says the same thing. Never invest them. The only annuity you should ever buy is a fixed annuity, not a fixed indexed annuity that's typically tied to some sort of an index. A fixed annuity is earning some percentage. Now, that's also very rare. You should probably never buy those either. They're very specific for a very small set of people. Probably less than 2% of the population should ever even think about buying one of those. But just annuities in general, not a great investment vehicle. Let's just say that. Anything to add, Luke?
No, just to echo what you said, really, some people may want to buy fixed annuities to do some sort of liability matching or something like that. But for most people, it doesn't make any sense. Fixed index annuities do this amazing thing where they typically cap your gains and charge you if you want your money back early. And so there's nothing really good going on there. So no, Definitely stay away.
And then you have surrender charges, which there's surrender charges because guess what? The person that sold that fixed index annuity, or this goes for universal life policies, whole life policies. They're all lumped kind of in the same basket. They are being sold because the seller of that annuity or universal life or whole life policy or permanent life policy are getting huge commissions, 5, 6, 7, up to 10, 12%, depending on the product. So that's why you don't want to touch them. So because the only reason they're being sold is to drive commissions for the salesperson. That's it. Not in your best interest. All right. Now, we have a lot of ground to cover in the next 45 minutes, and our main focus point regards this topic. Take it from Warren Buffett. Misses are inevitable. And I love this story because it's important to know that, hey, you win some, you'll lose some, but it's what it looks like over a long period of time that matters most. So we're going to talk about some Warren Buffett and his investment principles. We also have some other topics on the docket. One is in regards to utility stocks. Utility stocks are on a tear. Why is that? So we're going to look at that story. Also, corporate financing. It's on the rise, meaning companies are now able to borrow money at some of the cheapest rates in a while. And especially if you look at spreads between corporate bond rates and treasuries, they're pretty tight. And that means, hey, liquidity is flowing and financial conditions index is the lowest level since January of 2022. So we're going to look at that story. And then lastly, if we have time, have you ever tried to lend money within your family or thought about it? Well, what are the tax consequences? What are the structures that you should consider when potentially making this happen? So those are what's on the docket for us, but also your voice bank questions. One is on BCE Inc. as well as Best Buy. And we also have some questions that came in via the comment section over on our YouTube channel. And of course, we welcome your finance and investment questions right now at 888-99-CHART. But we're going into a short break. On the other side, we'll talk about today's market activity. But please remember, you can call anytime and leave your question on the InvestTalk voice bank at 888-99-CHART. We're here to answer your finance and investment questions. So make sure you give us a call at 888-99-CHART.
Do you want to take your investment strategy to the next level?
We invite you to visit InvestTalk.com and submit your portfolio for a free review from us.
This is a fantastic opportunity to receive personalized advice and insights to enhance your results.
Don't let this chance slip by. Go to InvestTalk.com, submit your portfolio, and let us help you on your journey towards greater investment success. Now, Luke, let's take a look at the market today. It was modestly higher, kind of a mixed bag overall. The value side of the market certainly underperformed today. You had large caps up about 12 basis points, small caps up 21 basis points. I guess it depends on which index you're looking at. Did you see anything that caught your eye today?
In corporate announcements, Target announced it would cut prices on 5,000 frequently shopped items, citing that they were seeing some pressure on consumers, as we saw from the forward-looking guidance from Walmart as well. Really just echoing the point that lower-end consumers seem to be struggling more in the recent past than they did even 6 months ago. I think for me, the most interesting part was that oil, WTI crude, was only down, or rather it was down at all, 40 basis points, especially in the wake of what's going on in the Middle East. There wasn't much of a big market reaction given the Iranian president died in a helicopter crash. It came out that King Abdullah of Saudi Arabia is perhaps nearing the end of his life, though for some time now MBS has been in charge of that country as the de facto ruler. But still, a lot of news coming out of the Middle East. The U.S. approaching the end of a security deal with Saudi Arabia as well. So interesting to see that oil markets didn't really move much given all that was going on.
Yeah, it makes sense to me, though. Like you said, MBS has been in charge of Saudi Arabia for some time, so I don't think it would be the crown prince passing, or it would be the king, right? Yeah, King Abdullah. He would, if he passes, I don't think that's going to be a big issue. So in Iran, there might be a new election, so it doesn't seem like there's any foul play. So it doesn't seem like that's going to kick up any geopolitical concerns, at least for now. What interested me was gold just kept going up again today. Silver as well. It did kind of close off its highs though, so I thought that was a bit interesting. Definitely seeing a lot of interest in gold, so maybe it's a bit overbought right now, but that certainly was top of mind for me to see, where does resistance start. The dollar was up a bit today, but it does look like it's starting a bit of a downtrend. And what's so interesting after last week was there continues to be expectation that the Fed will cut rates despite new highs in markets, which is not something you typically see, right? New highs in all-time highs in equities, and the Fed is looking to cut rates. I think that's why you continue to see that, right? There's no real pushback from the Fed to tighten policy in a material way. Now, the Treasury is likely, based on their borrowing trends going forward over the next 3-4 months, likely to tighten liquidity a little bit, but you still have a Fed that is there to help deal with that issuance that continues to be pretty drastic to the upside. So that's what I'm watching is, will there be an upset in the Treasury market? For now, it seems unlikely. Now,
yeah, and I will say that's a quick correction for me. It's King Salman. King Abdullah is the king of Jordan. That was my mistake.
There we go.
Mixing up my countries.
There we go. Well, you probably noticed that we are answering questions submitted via viewers to our YouTube channel. And here's one that came in recently. Anthony Lombardo says, looking to get your thoughts on starting a position with IBM as a play in the digital infrastructure and AI space. I don't know about you, Luke. I haven't heard IBM as a name that is a leader in AI. Have you?
No. Someone asked on Thursday about Intel, and maybe they could right the ship and get involved in the semiconductor space. But I haven't heard anyone talk about IBM in that respect.
Yeah. And earnings estimates for this year are supposed to be up 3%, and those trends are actually going south. Same with next year. It's supposed to be up another 5%, but those trends are and earnings estimates are going south as well. Last quarter revenues are up 1%. Earnings were up 24%. But, I just don't see it here. It has pulled back to some support. It's starting to get a bit of strength. But if you're trying to play AI and digital infrastructure, I would want to own a company that's ahead of the game, not that's old school and trying to catch up. And you've seen that as of late with all of their acquisitions. I remember, what was their acquisition a couple of years ago? It was a big one. I'm trying to remember what it was, but they paid a lot for it. And it's helped their earnings a little bit, but they still haven't made as much money as they did in pre-pandemic. Pre-pandemic made $12.81. And next year, it's supposed to make $10.46. So, if as an AI play, I don't see it. As maybe a legacy value play, maybe. But I don't even see it that cheap. It's trading at a high teens multiple for something that's growing below what the market, the average market earnings are growing. So, yeah. Besides the technicals, which are positive, at support, I'm okay with it in that sense, but I don't know. What about you, Luke?
Yeah, I tend to agree here. I mean, for me, it's more of just the fact that there hasn't been much growth. And so it's trading at essentially what the market's trading at in terms of a forward-looking multiple. So I wouldn't say it's too expensive, but it's certainly not cheap, right? It's not a cheap valuation if you're looking to get this for a bargain. So, for me, I think there's just better growth names out there. I don't mean growth in terms of relative valuations. I mean growth in actual year-over-year revenue growth. So I would look elsewhere, especially if you're trying to get into the AI space. I don't think this is the name.
I completely agree. And yeah, if you look at their cash from operations, and what's interesting about that, those earnings estimates is that, remember, they're buying back stock. Their peak in cash from operations was $19 billion in March of 2016, first quarter of 2016. Yeah. Now it's $14 billion now. And that's with acquisitions and everything. So everything is just trending negatively for this company. I would pass on it. Now we're moving into a short break. Give us a call now at 888-99-CHART. Hey, welcome to InvestTalk. I'm Justin.
And I'm Luke. Together, we're here to guide you through the maze of investing and give you insights that impact your portfolio.
Whether you're a seasoned veteran or just getting started, we've got you covered. The latest trends, opportunities, and expert advice. We take your calls every weekday at 4 p.m. Pacific and anytime on our InvestTalk listener line. Just call 888-99-CHART.
We'll bring you deep dives into market analysis and answer your burning questions.
So, why join us? To get ahead in your investment journey with strategies, tips, and knowledge that can unlock the full potential of your hard-earned money.
But first, hit subscribe, turn your notifications on, and let's start making informed investment decisions together.
Welcome to InvestTalk.
Now, if you are serious about improving your investing skills, I have some good news for all of you. My company, KPP Financial, is presenting a new InvestTalk Wealth webinar. It'll be hosted by myself as well as Luke, and the official webinar title is Quality Investing, Digging Deeper Than Dividends. And here's some of what we will cover from 1 to 2 Pacific time on June 11th. That'll be 3 weeks from tomorrow. And we're going to break down the importance of fundamentals like profitability and balance sheet strength, as well as how high dividend payers compare to their peers, and certain qualitative factors to help you avoid value traps and develop the ability to identify genuine opportunities. It's going to be free. The InvestTalk Wealth webinar, you will gain valuable investing insight. And it all happens once again on June 11th from 1 to 2 Pacific time. And so go to investtalk.com and register for the upcoming wealth webinar. Quality investing, digging deeper than dividends. Once again, it's free to attend, but you must register. And Luke, I'm excited about this webinar because we talk about it all the time on the show that it's not just about the dividend, it's about the quality of the business, the quality of the company, and that's what we're going to dig deeper on. That's why I know, Luke, you're a big fan of alliteration, so digging deeper than dividends has to hit home for you, right?
Oh, it certainly does, and I think it's an important lesson too, because we hear it all too often. People call in and they say, "Oh, I want this. I'm looking at this stock," and I look at it and I look at the fundamentals of it. I look at the technicals of it. And I think to myself, why is this person interested in this name? Then I see there's a 9% dividend yield, and so I think this is an important thing to go over. So certainly, I'm excited to talk about it with everybody who wants to come listen.
There we go, June 11th from 1 to 2 p.m. Pacific time. All right. Now today's focus point is about Warren Buffett. Everyone loves Warren, and for good reason. Good reason. He has built an incredible track record over the last 50, 60 years. And a cumulative return for Berkshire works out to 4 million%, Luke, 4 million% over the nearly 60 years since it began. So there's a lot of lessons to be taken. And most people search for the lessons of, hey, what should I buy? But we all know while Warren is a great investor, he's also human, so he makes mistakes as well. He's missed out on a lot of companies too. So what do you think investors can take from the simple fact that, hey, Warren gets it wrong as well?
Yeah, well, I think it's a lesson about his approach, right? He has always been the type of person who, with the late Charlie Munger, would look for companies that were great businesses at fair prices, right? I think originally he said he looked for fair businesses at really good prices, and it was actually Mr. Munger who taught him that you should be looking at great businesses at fair prices. And so when you have that type of investment philosophy, investment strategy, the reality is sometimes you're going to miss home runs. But most investors shouldn't be trying to do everything they can to find those home runs, because oftentimes you strike out, right? You have X amount of dollars, you put a lot of it in a company that is a pie-in-the-sky company, it doesn't go anywhere. And so having that disciplined approach is really trying to consistently get those names that are going to be a good return on your capital. And I think that's what his investment approach has been. And it's good to know for a lot of people out there who are just getting started or have been investing for a long period of time that everybody is human, including the Oracle of Omaha.
Mm-hmm. And he tends to focus on companies with strong business moats, and this is kind of something we're going to discuss in our webinar coming up in June is that you want companies that have some sort of competitive advantage that is durable, sustainable, and that typically manifests itself in higher profitability, consistent cash flows, etc. And historically, Warren had an aversion to tech stocks, mainly because he felt he didn't understand them. So it caused him to miss out on companies like Microsoft. And he was kind of late to get into the game on Apple as well. So, he even admits that they've missed a lot in the past, and he says, hey, we'll miss a lot more in the future. So, the lesson I take from this is you don't have to hit the NVIDIAs. You don't have to chase the sexy names that one up a bunch, okay? It's about consistency over time, because the vast majority of the names that go up a drastic amount in a short period of time, it's a flash in the pan, meaning it's driven that way because the average retail investor gets in, and retail investors are what we call weak hands. Okay, fund managers, pension funds, those are strong hands. They buy stocks, companies, they typically hold them for a long period of time. Like Warren. Warren's a strong hand, right? He ideally never wants to sell them. And so the point is that you need to focus more on a lot of singles and doubles and triples instead of the grand slam. And occasionally you hit the home run or a 3-run homer here or there. But if you're always after the grand slam, you're going to strike out far more than you're going to hit. And the end result is you're going to lose more than you actually win. So make sure classic investment principle: save more than you spend, invest regularly, don't panic during sell-offs, and focus on those quality businesses. Now, in the next Invest Talk, we'll look into this topic. Credit card delinquencies are increasing for maxed out borrowers. For all debt outstanding for student loans, delinquencies have been steadily rising since the fourth quarter of 2021, following historic lows during the COVID-19 pandemic. But that story is tomorrow. But for now, I'm Justin Klein with Luke Guerrero, and we are ready to take your calls at 888-99-CHART.
You are invited to be a part of our learning experience. Simply use the InvestTalk voice bank to record your finance and investment questions anytime, 24/7 at 888-99-CHART.
Love today's Invest Talk episode? We want to hear from you. Drop your investing questions in the comments below, and your question could be the star of our next segment. Subscribe and stay tuned to see if your question gets answered by Luke and I. Dive into the comments now and become a part of our next conversation.
Hello, Justin or Luke. Today I'm calling about Best Buy. It's a company I currently own, and I want to increase it to a full position. And I just wanted to know what the future prospects of it are. I'm also looking at a REIT called Public Storage, ticker symbol PSA. It's been on my watch list for quite some time, but I never bought into it. It still looks attractive, but I'm also looking to pick it up in the 260 to 270 range. So what do you think about these choices? Thank you, and I'll be listening on the podcast.
All right, looking at Best Buy and PSA, we're going to stick with Best Buy. It's hard to kind of do two stocks in one call. So for everyone out there, try to stick with one company here, and we'll do that with Best Buy. And this is a name that did very well during the pandemic. Earnings went from $5.32 in 2019 all the way to $10.01 in 2022. So it's earned $6 and a penny this year. It looks like 5% dividend yield. And this is actually a name that we own for clients as well. And a big reason for that is its profitability metrics. Return on invested capital, 31%. Return on equity around 43%. Now, that's higher than historically has been, but even pre-pandemic, its return on invested capital was in the mid-20s. So, we like the profitability metrics here. As well as the multiples. Why don't you tell the audience a little bit more about Best Buy's multiples, Luke?
Yeah, from a relative valuation perspective, it's trading only at an 11 times. Forward-looking price to earnings multiple, trading at a 5.2 times price to book, which is lower than it's been over the past 5 years. It's averaging about 6.2. But I think you nailed it on the head. Its profit margins are pretty good, and its return on assets, its return on equity, it's all looking good. I would say for the short term, there may be some good buying opportunities in this name, given that, as I mentioned before, especially the lower end of the consumer spectrum isn't doing as well. But as a long-term investment, certainly we think this is a good name.
Exactly. And you have free cash flow yield right around about 4 or 5%, which is pretty good. And no debt. That's what we like about it, too, is pretty much no net debt on its balance sheet. So we're going to give Best Buy a thumbs up. Now, Luke, let's talk a bit about the exciting world of utilities. And for decades now, the utility sector has been the lowest performing, the most stodgy, boring part of the equity markets. But all of a sudden, these stocks are becoming part of the exciting trade in the market, which is all around AI. And this year, 3 of the 5 best performing stocks in the S&P 500 are utility companies. And the best performing utility company, Vistra, it's up 143% this year. And guess what? That's even more than NVIDIA. Pretty crazy, right? Now, last year, the utilities index, Dow Jones Utility Index, was down 7.2%. So, and obviously the S&P was up a lot more. So there's some catch up here. But do you think this has some legs, or is this getting too caught up with the AI craze?
Well, I certainly think that it has some legs. I think one of the other things here is historically, people have tended to invest in utilities as a proxy for bonds, right? It's an income stream. It's very consistent. It's had some, I think, over the past 5, 10, 15 years, its biggest problem has been that growth prospects, right? Over the past 10 years, people have been trying to conserve. And especially in a time when people are worried about the issues of climate change, the demand side has been a problem. But now you have this new area that is demanding electricity. It's demanding power. And so there seems to be some growth prospects in a way that they haven't seen for the past decade. And so people are flocking to it, and they're doing well. An argument can also be made that maybe a lot of this is associated, like I said, with some people being concerned about where the market is standing, and this is a good way to preserve your capital and also get some income. So there could be multiple reasons why this is happening, but certainly I think that in my opinion, the demand side is a big driver of this.
Yeah, and that's interesting is in 2021, the U.S. used slightly less electricity than it had in 2007, even though the economy grew 3% annually over that period. So it just shows how much more efficient the economy was, at least energy efficient. And I think a lot of that had to do with the financialization of our economy. A lot less manufacturing facilities, which use a ton of electricity. And that's part of the story here is a revival of manufacturing after decades of companies moving offshore their production, as well as semiconductor production, which is highly energy intensive, and the government's supporting that. And then AI demand. And something I think is underappreciated is EVs. I think of EVs are still a small percentage of our overall auto fleet, but it's many multiples of what it was a decade ago. And all of that is being plugged into the grid. I, for one, my latest car is a plug-in hybrid. So, I plug that in pretty much every day and obviously run off electricity. So, I think this does have some legs to it. And now maybe some of them are a little bit too hot for their own good, and maybe they're a bit expensive. But I do think this is a more durable trend because I don't think AI is going anywhere. It's just a matter of how fast the uptake is. And as I just said, there are a lot of other drivers for that electricity demand as well. Now let's go to Brian in Ohio. Wants to talk about 401k.
Hey, how are you guys?
Doing well. What can we do for you?
First time live. I thought of a question. I was like, I think I'll call in and try to get it on the show.
Appreciate it.
It's a question about my 401k. I have recently left my employer, and I haven't talked to Human Resources yet, but I was wanting to know how soon I was able to roll that over into my Roth IRA.
Well, that depends on the employer. Usually pretty quickly. I don't see any reason why, as long as you are, you've left your employer completely, and they're not paying you anything else, severance, things like that. You should be able to roll that over. Yeah, you definitely want to talk to your HR department about that. Now, remember, if it's a 401k goes into your Roth IRA, that's going to be all taxable to you in this year. So you probably want to roll it over into a traditional IRA, and then over time convert that to a Roth, unless it's already a Roth 401k.
I have a percentage of it in the Roth, so I guess I don't know how that works. If I move, can you just move the Roth money in, or I don't know?
Yeah, so you're going to move the Roth 401k money into a Roth IRA, and then a traditional 401k money into a traditional IRA. If you don't have a traditional IRA set up, then talk to your broker, set one up.
Yeah, that's excellent information. I was thinking about just taking the money that was in there that was going to be taxed and just go ahead and take the hit, and then just pay the taxes for the year on that amount. But you can do it that way too, right?
You can do that. Yeah, it's all going to depend on your tax rate this year. You left your job, and if you have another one lined up, usually we say you kind of want to time those Roth conversions when you're in a relatively low tax bracket. I'm not sure what your tax bracket is. This is something that we work out with clients. So if you ever want to give us a call and kind of go over things, be happy to give you a sense of what makes sense for you.
I've been listening to the show since 2017. I learned so much, it's not even funny.
Appreciate it. Well, keep spreading the word, and good luck with that new job.
All right, thank you.
Thanks, Brian. Now, when people take the time to leave an InvestTalk podcast review on iTunes, we like to thank them for the courtesy by getting to their question quickly. Baby Dawn said, I was a buyer of TWI, Titan International, a maker of heavy equipment tires and undercarriages back in 2020 when it was around $4 to $5 per share. I wrote it up and have been out for a couple of years. It seems highly cyclical. I think it's a good company, a long-term operating history. Your opinion? Is it too early to get back in? I plan to start buying again around $5.50 and lower. Any chance it can get there? Well, the technicals are pretty poor, so definitely could get there. What are you seeing on this name, Luke? Is it truly a good company with a long operating history, as this reviewer says?
Well, it certainly has a long operating history, but a length of operating history doesn't necessarily mean success of a company. And over the past 5 years, at least, which is more important to its prospects going forward, its 5 year annualized growth rate is 2.6% on revenue. And most of that actually happened between 2021 and 2022, and then reverted back downward. So, in terms of growth, it doesn't look great. In terms of operating cash flow, it looks okay, not fantastic. Its margins are shrinking as well. I just think the market is telling you, it's at this point trying to find support. This seems to me like a catching a falling knife scenario. Now the question was, what about down at $5? Well, maybe, but it's fallen from 15 down to 5. Or rather, where it is now at 8 in about 6 months. I don't know. It just seems to me like this is the type of name that maybe you would want to stay out of. It's technically very, very, very poor.
Yeah, and my issue is the market cap's $632 million, and it's a small cap. That's not my main issue. It's the fact that there's also roughly $400 million in net debt on its balance sheet, meaning it's a fairly levered company, and the times interest earned looks to be headed downward. It was at 8, now it's at 5.6. It was negative during COVID, and even pre-COVID, it flirted with negative territory, especially back in 2014 and 2015. So I think you caught it well during the pandemic, but just because it had a big move during the pandemic and it benefited, doesn't mean that those benefits are durable. And you see right now, the last quarter revenues are down 12%, earnings down 45%. Earnings last year were down 28%, and it's supposed to be down another 43% this year. So you line all this up, nothing looks very positive for this name. And at 550, it would need to find support, and I need to be confident that that debt can be sustained. So to me, this would be very low on the list of priorities to buy over the next 12 months. There's much better names to use your capital on. Thanks for the call. Let's go ahead and fit another question from our InvestTalk YouTube channel. David Shepard says, I know you are well aware of the breakout in spot silver price. I own silver through PSLV, Sprott Silver Trust, as 4% of my portfolio and have 40% gain on it. Do you think it's time to add to the position, chase these returns a bit, or sell into the new highs? It's to me, the first two questions are the same, right? If you're chasing it, you're also adding it here, right?
Yeah, sounds the same to me.
Yeah, I'm still bullish on silver. I think commodities are just starting to break out, and silver and gold, we're going through a long consolidation period. So I think there's more room to run. Now, near term, it is a bit overbought, and I would be waiting for a bit of a pullback in silver prices, but you're probably not going to get a dramatic one. Usually when any asset's in an uptrend, it doesn't really give you the opportunity to get in. You don't get a 15, 20% pullback. You get minor, mid-single digit pullbacks, and that's your opportunity to get in. So, that's the way I would think about it. And I would look at your overall portfolio, exposure to basic materials, precious metals in general. 4% is not too high, but what else do you own in addition to that? And that would be a more broad question, but definitely not something I'd be quick to sell on this breakout. Now, looking at the clock, I think we can squeeze in one more question here. So let's play it now.
Hi, guys. Appreciate what you do for all of us. Listen to you on the podcast. I have a long-term position in BCE, Bell Canada, and I've used it basically as an income generator, bond proxy type product. And here lately, the price has taken a nosedive, and the yield is getting a lot higher. I'm not sure if I need to back up the truck and buy more or run for the hills. Can you give me a little advice? Appreciate everything. Thank you.
All right, looking at BCE, this is a Canadian telecom firm. Been around a long time, yields 8.25%, and this is the perfect example of a name that you want to run for the hills on. This is a name with a ton of debt on its balance sheet, roughly the same amount of debt as the market cap, around $31 billion market cap. And, its profitability metrics are pretty poor. So this, to me, is the perfect example of a name that a value trap, a dividend trap, whatever you want to call it. It has been in a strong downtrend really since the Fed started raising rates in early 2022. It peaked out around 58. Now we're at 34, Luke. Oh, that's a rough ride. You think you should dump it as well?
Yeah, no, I do agree here. I think that this type of business is very capital intensive. And so it makes sense that over the past couple years, it has been performing poorly. It's way too much debt on its balance sheet. Certainly, its declining profitability and cash flow won't be able to sustain this level of dividend yield. So I would just head for the hills.
Yep, there we go. That was BCE, which is one of the largest Canadian providers of wireless, local exchange, long distance internet, and digital TV services. There we go. Now, as we go into a break, I want to remind you again that the KPP Financial InvestTalk Wealth Webinar is hosted by myself and Luke. The title is Quality Investing Digger Deeper Than Dividends. It's all new. It's free to sign up. Just head over to investtalk.com. You'll get the chance to participate in an interactive Q&A session after our presentation as well. And once again, it happens all online Tuesday, June 11th from 1 to 2 p.m. Pacific time. Just head over to investtalk.com right now to register for our upcoming wealth webinar. And now, my phone lines are open, waiting for your calls at 888-99-CHART.
The stock market is constantly changing, and serious investors want a way to get the latest news and unbiased investment insights. Welcome to the InvestTalk podcast.
Enjoyed our insights on InvestTalk?
Great news. Our podcast is available on all major platforms.
Make sure to subscribe wherever you listen to your podcasts.
And get the latest in investment advice across Spotify, Apple Podcasts, and more.
Subscribe now and join our community of informed investors.
Hi, Luke and Justin. Calling about bonds and treasuries. I understand that's fixed income, so if I have a 5% bond or treasury and I buy a 15-year duration, for example, does that mean that I am in 15 years annualized 5% off of that money? And since interest rates are high right now, but I do believe they might be coming down, will the actual principal or the bond / treasury move up in price, generating a little more yield than as of right now? Just trying to get a grasp of this. Love what you guys do. Thank you.
Well, if you bought a 15-year bond, treasury, whatever bond that is, and there's no default, right? With the treasury, there's not going to be a default, and its yield is today is 5%. That's what you're going to get, 5% annualized if you hold that bond to maturity. Now, if interest rates do drop between now and then, right, over the next, say, 5 years, that bond will appreciate to some degree. But is still, if you hold it till the end, you're still going to get that 5%. So you're basically just getting front-loaded a little bit more return if bond prices rally, interest rates drop, etc. Is that as simple? Would you add anything, Luke?
Yeah, I would just clarify. You have to separate what you can get for a bond on the market versus what you get for holding the bond based upon the bond's covenants. So if the price of the bond appreciates, it's not that you get more in principal at the end. The bond covenants are what the bond covenants are. You're yielding 5% annualized every year, and then you're going to get your principal back in this case. So if the price goes up, you can sell it for more on the market, right? Because interest rates have fallen, so there aren't these 5% bonds anymore. They're worth more. But it doesn't mean that you actually get the price appreciation if you hold it to maturity. So just realize the difference in the dynamics between what happens on the secondary market and what happens with the issuer of the fixed income security.
And we're a believer that long-term, actually, rates are going to continue to march higher. Obviously, you'll have years and quarters where interest rates fall. But in general, we're in an inflationary environment. So you typically get higher rates there. And we say shorter duration. 15 years would not be shorter duration. That would be relatively long duration. If yields go from, say, 5% where they are today to 8% in 5 years, and you have a 15-year bond that still has 10 years left, guess what? You're going to be down significantly on that bond. So just think about that when you are buying bonds in general. Now, Luke, there's an interesting little data point here from the Chicago Fed's National Financial Conditions Index. It reached its loosest level since January of 2022, right before tech stocks peaked, and you had financial conditions tighten. So that's despite much higher interest rates. The dollar is roughly flat since then. So it just goes to show you, though, that just because rates are higher doesn't mean that the economy has to go to hell in a handbasket and that all of a sudden there's going to be this massive wave of defaults, right?
Yeah, that's true, but it's also to the point you just made, which is if you're in an inflationary environment where rates are going to be secularly higher in the long run, the thing that would tend to drive rates down would be the economy overheating or the economy collapsing or breaks happening somewhere through the financial system, and that's just not what you're seeing. With credit loosening, that's even less of a reason for the Fed to need to cut rates because then they can be more worried about the return of those inflationary impulses, and they can focus more on that, which means keeping rates higher for longer.
And when you have inflation, guess what companies' profits do? They go up on a nominal basis. Remember, profits, the stock market, these are all priced in nominal terms, not in real terms. So when you think of inflation, and everyone has their eye on inflation now, they're not paying attention to the second order effects that happen with asset prices, meaning higher interest rates, you're already seeing that. That's one second order effect, as well as higher levels of earnings, which makes it easier for companies to pay back their debt. And that's why you have the bankruptcy filings still at relatively low levels, although they're rising, but from very, very low levels. Well, that about does it. I'm Justin Klein, here today with Luke Guerrero, and this completes another InvestTalk program. We thank you for listening. We encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, Google Play, and be sure to rate and review on iTunes as well. And I hope you've heard that the InvestTalk podcast is now available in video form over on our YouTube channel. Just head over there and search InvestTalk with 2 T's. Independent thinking, shared success. This is InvestTalk. Good night.
Hey everyone, if you enjoyed this video and want to see more amazing content, make sure you hit that subscribe button and turn on notifications.
Your support means the world to us and helps us create more videos that you love.
Subscribe now and join our community of savvy investors.